Okay, guys, so this is one of the most important things you need to be able to do, one of the most important concepts you need to be able to work through when it comes to capital flows and the loanable funds model. We need to be able to discuss how uh, capital flows in regards to the interest rate or the rate of return in a given economy or towards one economy and away from another economy. So if you haven't done this problem yet, then I need you to pause the video right now and you should kind of take a look at this and see if you can wrap your head around what's happening. Once you've given it a try, or if you get stuck, then unpause the video and get going. So one more time, pause right now if you haven't done this yet. Okay, and if you are ready to go, then let's hit play again and get going. So the problem sets up that we need to show, and I have it set up already, a United States loanable funds market with an interest rate that is higher than the interest rate in China on their loanable funds. So I've got a United States loanable funds market on this side with an interest rate equilibrium around 10%. And I've got China's loanable funds market on this side with an interest rate around 2%. And one of the most important things to notice is that it doesn't necessarily have to be an economy where no capital flows, but for our purposes, we'll start under the assumption that there is not any capital flow happening between these two nations. So the United States, that amount of savings is providing 10% real returns to people who are demanding it, and China is doing 2% real returns with their amount of savings. So the question is, if we were to kind of open up capital flows, then what's going to happen, right? So like, how does capital flow respond to this scenario? Right? That's really the big question. What is going to happen to capital flow in response to two countries with these different interest rates? So let's start on the China side, which I think is maybe a little bit easier, right? So once capital flows are available, once people are given the choice of where they want to save their money, we can begin to think that something kind of straightforward is going to happen, right? People in China will prefer to save in the US given the higher interest rate, right? 10% return is better and preferred to a 2% return for our savers, right? So savings is going to move towards the United States. We could also imagine that maybe if there were capital flows happening here, that people in the US will stop saving in China. And really, this doesn't only have to be people in these two countries. It might not be people in the United States. It might be people all over the world, right? Anybody in the world is going to prefer saving in the United States over saving in China, given the parameters of a higher interest rate in the United States and a lower interest rate in China at this time. So how do we show the decrease in savings in China? Well, a decrease in savings is a decrease in the supply of loanable funds. So I shift my supply of loanable funds for China to the left, SLF2, and we can say really that China is experiencing a capital outflow, which is going to slowly but surely raise the interest rate in China to R2. Right? And what we can see here, the change in quantity, that is the amount of capital that is leaving China. That is the capital outflow. Right? Meanwhile, we can say the opposite is happening in the United States, right? As people prefer, right? The US is the preferred place for savings because of the high interest rate. Then we will see an increase in savings, specifically foreign savings, which leads to an increase in the supply of loanable funds. And we can shift this curve to the right, SLF2, right, an increase in the supply of loanable funds, which represents that the United States would experience a capital inflow. And that capital inflow will, as we can see on this graph, increase Q, there's our capital inflow, and will also decrease down to R2. And I didn't quite hit it here, but the real hypothetical here is that these two graphs should almost align with each other, because if these economies are truly kind of interchangeable in terms of where people would prefer to put their money, then we should begin to see a balance of interest rates. That doesn't always happen in the real world. It especially doesn't happen when the two economies are not really comparable to each other, but it can happen, and it does happen between economies that are generally similar to each other. But let's step back and just summarize kind of what we did here. What we just looked at and what we graphically showed is that capital will flow to higher interest rate economies, and will flow away from low interest rates. So this is inflow when there is a high interest rate, and outflow when there is a low interest rate. And that will lead to what we would kind of call a balance of interest rates. That will start to bring interest rates into alignment. An economy that experiences an inflow will begin to see a decrease in the real interest rate. An economy experiencing an outflow will begin to see an increase in the real interest rate, in the case of the United States and China, as we just put up here, right? So that is your big takeaway. All of this seems a little not super important at the moment, as a lot of economics can, but this is going to become really important when we get to our next step, which is about exchange rates and why people might prefer to have one currency or another currency. And what we're beginning to see here is that interest rates and capital flows are a big part of driving which currencies and which assets people are trying to hold at any given time. As a final piece here, I don't think you're ever going to be required to draw this entire modeling situation, but the root of this question, right, this question, if the interest rate is higher in the US than in China, right, then there's the logical question, what happens to capital flow? That is a question you should be prepared to answer, and we do need to be ready to answer. So we'll come back one more time. The big solution at the bottom, the big takeaway at the bottom, right? Capital will flow to the higher interest rate. Oops, I moved to my eraser. That was a big mistake, right? Capital will flow to the higher interest rate and will flow away from the low interest rate, right? Capital flowed away from China and raised their rate. Capital flowed to the United States, which eventually lowered the rate in the United States. All right, practice this and send me any questions. Good luck.